This video addresses an issue that I talk to my buyers about all the time, and that is, why do sellers care so much about getting a non-mortgage contingent offer? I have a mortgage contingency because I can't afford to buy the house without it, but I'm pre-approved, my credit's good. There's no reason why I shouldn't get the mortgage. What's the big difference? Why is it that sellers prefer so strongly these non-contingent offers? The answer is because a mortgage contingent offer provides some outs for the buyer. So the first thing is, even when a buyer has been pre-approved or pre-qualified, the mortgage company does not go into all of the detail and getting all of the documentation until after the property is under contract. And even with a pre-approval or a pre-qualification, sometimes once the lender does their due diligence, they come back to the buyer and say, oh, well, we didn't realize this or that or something else. We're sorry. Even though we gave you that pre-approval, we can't give you the loan. In a scenario like that, if the buyer then backs out of the deal, which they would, they get their deposit money back. Another part of the mortgage contingency is what's called the interest rate cap. There's a spot to write in the highest rate at which the buyer is agreeing to still move through the transaction and go to the closing table. If for some reason, by the time that the buyer is able to lock in a rate, rates have risen and the buyer can't get something below that cap, that part of the contract, again, allows the buyer to terminate the contract if the buyer chooses to, with the return of all deposit monies. The biggest out that mortgage contingency paragraph offers the buyer, though, is the appraisal. So the way a mortgage contingency paragraph is structured in a Pennsylvania agreement of sale, if it is filled in properly, creates what we refer to in the industry as an automatic appraisal contingency. And basically what it means is that if the property appraises for any less, and I mean even a penny less than what the agreed to purchase price is, that also entitles the buyer to walk away with the return of all deposit monies. So these are just three ways that having a mortgage contingent offer is not appealing to a seller. So, because those deals can fall through and then the seller has to give the buyer their money back and start all over again. And keep in mind, it is very unusual, particularly when you have a competitive market like we do now, for a seller to get the same amount or more if they have to go back onto the market with a property that has had a fall through. So what I mean is that if they have a fall through sale transaction, it doesn't work out because of the mortgage contingency, and then that property goes back up on the market, agents can see that it went off the market, now it's back. People make assumptions, they can be incorrect or correct, about why that is, but almost inevitably that initial buzz and competition has changed, and it's very rare for a seller to get as much as was offered originally. So that may make it a little clearer why sellers do not like mortgage contingent offers, and they may be much more likely to take one that's slightly less as far as the purchase price if it doesn't have a mortgage contingency.